everybody. Welcome. This is Brett Swartz with Capital Gains Tax Solutions. We have the pleasure of having the National Sales Training Director for the estate planning team. Actually, I think it's just the National Training Director for the estate planning team. It's Michael McIntyre, and he's going to share some wisdom with us. In particular, how the Deferred Sales Trust tool applies to financial advisors. And so we're going to go here. So welcome, Michael, to the call.
Thank you, Brett. Michael McIntyre. I'm the National Training Director for the estate planning team, and we're happy to have you here and to talk to you about the structure and how the Deferred Sales Trust is a helpful tool for you to gather assets and to understand how it's a whole nother market and an opportunity for you to gain new AUM, assets under management, to acquire those assets at a low to no cost and retain those assets for years itself.
Excellent, excellent. And Michael, as a quick background, maybe you can give us a little bit of how you came to learn about the Deferred Sales Trust and also your professional background.
So about 12 years ago, I sold my own practice as a registered investment advisor. In doing so, I paid a lot of capital gains in doing so, and 2 years later, I discovered the Deferred Sales Trust and kind of kicked myself for paying all of those taxes, particularly in California. And I saw that not only is this a good strategy would have been a good strategy for me to exit, but it's a fantastic opportunity to acquire, to have retained or receive clients. The reason that I got the amount of money that I did was mostly from charitable remainder trust work, which you have to find somebody philanthropic to work with who's interested in giving away their money. So I used to say jokingly, for every 1,000 of deferred sales trusts, or excuse me, of charitable remainder trusts that I came across, I would do one, and you'd find that. With the Deferred Sales Trust, the number is much smaller for rejection purposes. You kiss less frogs, in other words, that turn into princesses, and you retain them, because when the client dies, unlike the charitable remainder trust, your money doesn't go away. The money stays on and on and on generationally, which is an important point, because if your client book is built on, number one, a high acquisition cost, and then if death, they get hit by a bus or whatever it is, and your customers go away, it's an expensive endeavor for marketing. And this is just the opposite.
Excellent. Which kind of leads us into our first question, Michael. Given your experience in the industry for lots of years here and learning about the Deferred Sales Trust, but what would you say is the biggest problem financial advisors are facing or having before they discovered the Deferred Sales Trust?
Yeah, I think that a lot of us in the financial services business are never really taught how to acquire a customer, how to get or how to prospect. We are told how to pass a test, pass the Series 7, pass the Series 65, and basically we're told ultimately how to sacrifice ourselves. There really isn't that many businesses that your whole training and everything about you is about giving up your own profitability in favor of the client, fiduciary responsibility, right? And so nobody teaches you how to identify, find a client, and gain it. When I started in this business, 35 years ago, they gave me a New York phone directory, a phone hanging out of the wall, and a list of stocks. They said, this is what you're going to sell. Okay, here are your clients, pointing to the New York phone directory, and here's how you're going to contact them. So, fortunately, cold calling back then was a little more effective than it is today, which is not effective at all with a lot of other things. And today, I think it's evolved itself into the ability for you to do, seminars. And you're doing these expensive seminars, which can the rubber chicken kind of thing, and then it develops into a client. But there's a law of diminishing returns with that. As people find out, it's very expensive to acquire that customer, and it's very easy to lose them.
Got it. Yeah. So the value proposition and also the ability to attract high net worth clients, and also what you're selling seems to be the challenge. And what would you say that frustration feels like to try to solve that problem, not having a tool like the Deferred Sales Trust? What are financial advisors feeling right now in today's competitive marketplace?
Well, I think, as I've said to many people in this business, is that this is the greatest, worst business ever known to man, right? It's really great when you're prospecting and things are working. It's really awful when you've got compliance issues or you're not acquiring customers at a great rate. The big picture of this, as we take a step back, is that the country's private net worth is roughly about 110 trillion. I get that from the Federal Reserve, which last published the number at about 93 trillion. I don't know, about 3.5, 4 years ago. Moving that forward with our current GDP, we're probably in the 110 trillion. Most of that money that has been built up in private net worth of that $110 trillion is in real estate and private equity. What you've been taught all of your career is to go after the liquid dollars. And I'm not going to stop you from going after liquid dollars that's in, your competitors. And while that industry has democratized, 30 years ago, some of the big names meant something. Now they mean a lot less, as you know. And so the private net worth of real estate and private equity is more than twice as much as what you are trying to do a takeaway from, a zero-sum equation. You're trying to take it away from XYZ firms so that you can get it. But the bigger money is locked into capital gains in real estate and in private equity, and that creates two issues. One is that somebody has an urgency issue, which is that they want to sell, okay? And secondly, they have a whole lot more money than other areas. And third, you can really eliminate your competition by having your money as pre-tax dollars rather than post-tax dollars, which effectively, if you're working with 40, 50% more money than your competitors from the start, you're already halfway around the track. Think of it, I don't know, you're running a 400-meter race, and if you're already halfway around the track, you have to screw up pretty bad in order to be first at the finish line. That
makes sense, Michael, and it's actually a little bit of my background being a commercial real estate broker. It's very similar in that if everyone's offering the same thing, and not actually solving the biggest problem, which we found is capital gains tax and the depreciation recapture, then at a certain point they start to feel frustrated and almost like their hands are tied to offer the value proposition that they really want to offer and get traction in their business. And so tell me now, Michael, what is different about the Deferred Sales Trust as it pertains to these challenges we've been talking about? And maybe you can explain briefly what is a Deferred Sales Trust for our listeners who don't yet know what this is.
Yeah, great point. At the core of our core competency, is the ability for us to solve problems on behalf of our clients. If we're not solving problems, then they're going to go someplace else. And one of the biggest challenges that people face is the ability to have taxes at the end of the sale. Say, for example, you have a $5 million building and you paid $1 million for it, and you've been so blessed that now it's worth $5 million. You have $4 million of a capital gain. You're going to lose 30%, if not more, depending upon what state you're in, of your taxes. So you're selling something at $5 million, but it's quickly going to become $3.5 million, very, very quickly. 3.5, maybe 3.8 million. The ability for you to invest the full $5 million puts you halfway around the track, like we talked about on that 400-meter track, to eliminate your competition. What the Deferred Sales Trust does is that we've been doing it for about 24 years, a strategy to defer gain on behalf of the seller. So if the seller is able to defer the gain, you're able to manage $5 million or very close to it, minus the legal fees, manage that $5 million versus your competition talking to them about the $3.5 or $3.8 million. So your AUM is larger, and you have just pulled the thorn out of the tiger's paw. So you're going to get some gratitude with getting their other capital versus and distinguishing yourself back like what you said, distinguishing yourself as being somebody different, somebody who is truly solving the deep problems of the client, rather than having the same democratized comment that everybody else is, well, I'm better than the other guy and my money management skills are better. You've already added from the very beginning of the conversation, right? You've added 30 to 40% money to the client than your competition. On the other hand, your competitors, remember that a 30% loss requires a 60% gain, and that's after tax. So that'll put you years ahead. It's a time machine for the client that you put them on that track for. So the Deferred Sales Trust allows you to defer the gain, manage all the money for the client on a proven strategy that has been around for about 24 years.
Excellent. That's a great summary. And maybe you can also share a little bit in the research. The estate planning team, for those who don't know, are about 1,300 professionals across the U.S., of which a large majority or a large percentage of those are financial advisors now. Can you maybe take us to the moment when either yourself and or one of the top financial advisors with the estate planning team who joined, and they finally realized that the Deferred Sales Trust was actually working to solve their problem and whatever problem they were facing? Can you give us kind of a story or just a general theme that you've seen for the advisors that have joined?
So I think the breakthrough where that epiphany happens for the advisor is the actual experience of talking to perhaps that prospect that they couldn't get, or that prospect that they weren't getting anywhere, but suddenly they talked to the client. I can remember a story where an anecdotal story of one of my reps that we trained who spoke to one of his clients many times, and suddenly he was selling his business for about, his share was $52 million. Now that's a bit larger than our average transaction, so I just want to make the disclosure that it's a lot larger. The client was a elusive prospect. He was a prospect. He had done, I think, a little bit of business with the advisor, but suddenly he was in this position of being able to talk to this client about $52 million instead of talking to him about, I don't know, whatever money that he had with him, which was, pennies in the conversation. And not only did he get this client's attention, but the seller, this client, was perhaps about 2/3 of the selling proposition. So he got the attention of the other group, because certainly the other investors in the program, because that 1/3 was obviously interested in deferring their taxes as well. So he'll gain. The deal's not done yet, but we have many examples. That was just one that was just in the last week that I could think of. So he's going to manage $52 million, whereas I think the amount was somewhere in the neighborhood of $29 million post-tax, because almost 100% of this is in California. So in California, we have a lot more taxes. So you've got to temper that a little bit if you're in a different state, but California is 37.1% in taxes. So that breaks down to 20% federally, 3.8% on the Obamacare tax, or called the net investment income tax, commonly called the Obamacare tax, and then 13.3% on the California tax. So add up all your fingers and toes, that's 37.1%. Let's just call that 40%. That means that your client has to make 80% return, roughly, net after tax. That's like 20 plus years for you to, and so the client, when he said that the client saw all this, and we showed them in black and white through the website, we have the ability, in our training to teach you how to enter the case into the system, and then we, as professionals, can present this. When the client saw that, he was next to the client, and the client looked like, I don't know, like the Home Alone kid with his hands to his face and his mouth open, Edvard Munch, the screamer, and the client was just amazed that this would be a game changer. And occasionally, the CPA might be reluctant or skeptical, but along the way, ultimately, the CPA or the, whoever that is, if they're skeptical, they don't write the check, that multi-million-dollar check that, your client does. So it's a great conversation starter, and our advisor is going to get a pretty healthy assets under management here that is a game changer for the advisor itself.
Excellent. Thanks, Mike, for sharing. And also, too, just to know, there's been over 2,000 closes in the 24-year track record. And have there been any audits, Michael, or what's been the? And also, maybe you can talk about just some of the deals. I mean, commercial real estate closes, artwork, collectibles, primary homes, all of the above. What does the Deferred Sales Trust work for, and what's the track record of the legality of the audits?
Yeah, so I think we're closer to 5,000 in our odometer of deals. I don't know the last one, but we're well over 5,000 trusts that we've done. My understanding is that we've had 14 no-trigger, no-change audits, over the time. And that means, no trigger means that we weren't the reason for the audit. Our structure isn't the reason for the audit. All your client gets is, a 1099 INT from the trustee. I don't believe that if the 1099 INT is done properly and filed properly, that should never be a reason for your client to have a trigger for an audit. There's 2 points. One is you don't want to raise ire to the IRS, which is the no trigger part, and the second is that you don't want to have any changes to the audit itself. So for that reason, we also, as a structure, our law firm, Campbell Law, will indemnify the client for any audit protection itself. And so that's an important point, and we also do everything based on contingency. Our law firm doesn't charge anything unless the transaction is completed and to satisfaction of the client. And they usually are, because they have on one side, they can pay lots and lots of taxes, or they can pay a very small legal bill. It's usually better to pay the small legal bill in that efficacy than it would be to pay the tax bill. So did I answer all your questions?
Yeah, it does. Makes sense. So tell us what life looks like if I'm a financial advisor considering, learning about the Deferred Sales Trust tool and potentially even joining the estate planning team. What does life look like once, those problems or those challenges are solved or are being solved? Or I guess another way to put it, what's business like after the Deferred Sales Trust is implemented? Our founder, CEO, Robert Binkley, has a great visual descriptive term for it. It's as if, and he's been a very, very successful advisor over the years. And he says it's like if you were a farmer and you were plowing a field. On one side, you can plow the field that everybody else plows and go after that. Or you could plow an entire new field
that is virgin from that standpoint, ripe and ready to harvest, that is available, that's almost like, I don't know, like a parallel universe that you've never seen before, which is this real estate. People right now are in your area, in your neighborhood, that wish to sell large real estate transactions, or need to sell businesses, and may also have collectibles such as artwork and other items that are embedded with capital gains. That imputation, if you will, imputed value of capital gains prevents them from either selling, listing, completing the transaction, or having quite a bit of pain when they do it. Being the ultimate problem solver that you are the white knight, if you will, that gets to resolve their tax problems and gets to invest their money. So it puts you in a different position. It opens up a lot more capital. And what most people, the combination of how you get a client, I've always thought, was a urgency on behalf of the seller. They've got to trust you, and ultimately there has to be a lot of money in order for you to have a client. I think the Deferred Sales Trust sets up that dominoes up really beautifully, in that you've got a client who's got an urgent problem, taxes. It's an impending problem. It isn't going away in most cases unless they die in a step-up basis, if it even qualifies. And so you've got a client that has to utilize you, for that benefit, for that to happen. And so you get to be that problem solver, and it puts you in a unique position in changing the dynamics from you competing, like I said earlier, from a zero-sum game, a winner-loser. I am better, in other words, if I'm you, the advisor, I am better than everybody else. Clients don't always believe that, okay? Just saying, because there's a lot of different choices. Or I'm starting you off with 30 to 40% more money. That's a definitive term that they understand, that you are starting them off with more money. And even if you are, even if they believe you, then that's great. But you're trying to solve that trust problem. It bridges that gap to them trusting you when they see that they are already starting with more money in the equation.
Excellent, Michael. This is great. And so I'm taking the top 5 reasons a financial advisor should join the estate planning team. You're going to be able to add more value to your clients. You're going to be able to differentiate yourself from your competitors. Hopefully, you're absolutely going to give clients flexibility and freedom to retire from their properties, their businesses. Also, the ability to diversify and have liquidity, because once those funds are in there from an illiquid asset, they can be put into a portfolio of liquid investments that are based upon what you, the advisor, advise and what their risk tolerance is. Hopefully, earn more referrals is number 4, and at the end of the day, grow your AUM, grow your business, and earn more for your bottom line paycheck.
Yeah, I think that's a beautiful summary. I might just add to it is that nobody ever teaches you in this business how to acquire a customer at no cost or low cost, how to retain that customer for a long time, and how to eliminate your competition. How do you retain a client generationally for long periods of time? If all of your clients got hit by buses right now, where would your book be? How would you prospect tomorrow? How could you find a system that could identify and find clients who have urgent problems right now that you could acquire at no cost based on the relationships that you might already have with business brokers or mergers, acquisitions, commercial realtors? All of these people are dying. Actually, they need help. This industry has not only been democratized for you, but it's also being democratized in unique ways that is requiring them to molt in different unique ways as the market changes. And if you can solve their problem, not just the clients, but solve a unique group of people, such as business brokers, mergers, acquisitions, and commercial brokers, to train them to solve the problem for the clients. Remember, how much money does a business broker or a commercial broker make if the transaction doesn't happen? That would be zero. So as you help them, you've pulled the thorn out of their foot, and they become, as Robert Binkley liked to say, fishermen for you. And they develop into what we call our professional partner network, which we can talk about and train you on how to do, setting up that monetization, right? That group of people that are going to monetize, or are going to become your own fleet of fishermen, as Robert says, that are going to be uniquely qualified to provide leads for you at a zero cost, zero out of pocket marketing system that you've never seen before in your life. And we welcome you to take a look at this as an alternative. We want you to keep marketing the way that you currently are. We want you to take a look at this as an adjunct to what you might do to double, triple, potentially, whatever you could do with other methods of other marketing and retain these clients for long term. We just, Robert and I have met up with clients that have been with us for generations now. We're now entering into that realm where people are retaining us. And why? Because people want to pay the taxes, as Robert says, the seventh day to never. They don't want to pay taxes. That retains your ability to retain them for a client and changes the narrative from, gee, I'm better than the other guys, to I'm keeping you away from the tax man, right?
Makes sense, Michael. Well, I want to thank you for your time and also invite anyone who's watching this video to reach out to us. We do no-cost webinars and educational events to train and equip you with the Deferred Sales Trust tool. So feel free to reach out to us, and we'll connect you and with the estate planning team and with Michael McIntyre for specialized training. And we appreciate your time, and you can reach us at capitalgainstaxsolutions.com, or you can also reach us at 916-886-2986. And that'll wrap us up for today. Thank you so much, Michael. Have a great day.
Thank you. Take care, everybody. Looking forward to talking to you in the future. Bye now.